By 2026, over $500 billion in decentralized finance liquidity could face immediate regulatory seizure or be rendered entirely untradeable. This isn't distant speculation. It's a calculated risk emerging from a coordinated global push by financial institutions and governments. They are engineering a new financial landscape where anonymity becomes a critical liability. After 15 years dissecting financial markets on Wall Street, I've seen how global regulators operate. They don't just react, they strategize to integrate or neutralize. Their strategy for crypto, especially DeFi and privacy coins, is clear: exert control, impose transparency, or contain. This isn't about your benefit, it's about preserving their established order and mitigating systemic risks. The primary mechanism is the escalating compliance burden. Regulators aren't pursuing an outright ban. Instead, they're constructing an environment so complex and costly for non-compliant protocols that it strangles innovation and limits retail investor access. The Financial Action Task Force, or FATF, for example, has pushed its travel rule for virtual asset service providers since 2018. By 2026, this rule's tentacles will extend beyond centralized exchanges, directly targeting DeFi infrastructure. Consider Project Athena, a hypothetical DeFi lending protocol with $2.5 billion in total value locked. Under new mandates, like a Global Digital Asset Integrity Act of 2025, any protocol facilitating anonymous transactions exceeding $1,000 without robust Know Your Customer (KYC) compliance would be flagged high risk. This could trigger a 75% increase in operational costs, or lead to complete delisting from major front-end aggregators by Q3 2026, isolating liquidity and rendering assets inaccessible. For the individual retail investor, this shift carries significant implications. Your ability to interact with decentralized applications, or even hold privacy-focused digital assets like Monero or Zcash, could become severely restricted or impossible. The resulting value erosion won't stem from market fluctuations, but from engineered obsolescence driven by regulatory pressure. This is a direct threat to your holdings' utility and long-term viability. Now, let me show you precisely which types of digital assets are most vulnerable, and why. The most exposed digital assets fall into two categories: privacy-centric cryptocurrencies and unpermissioned decentralized finance protocols. Their core design, prioritizing user anonymity and censorship resistance, directly conflicts with the global regulatory push for financial transparency. Regulators, driven by anti-money laundering and counter-terrorist financing mandates, view these features not as innovation, but as conduits for illicit activity, underpinning upcoming legislative frameworks. Consider digital currencies like Monero, Zcash, and Dash. Their embedded privacy features, ring signatures, zero-knowledge proofs, obfuscate transaction details and participant identities, making them primary targets. The U.S. Internal Revenue Service, for example, issued bounties in 2020 to companies tracing transactions on these networks, demonstrating intent to pierce their privacy. Global financial cooperation, initially focused on Bitcoin traceability, now extends aggressively to these private alternatives, aiming to render them unviable within regulated systems. Similarly, unpermissioned DeFi protocols, operating without central gatekeepers or mandatory identity verification, face an existential challenge. Picture a lending platform where anyone deposits and borrows funds solely with a wallet address. New regulations, like the EU's MiCA framework, are moving towards holding developers and front-end operators accountable for compliance failings. This creates a dilemma: introduce intrusive KYC, sacrificing decentralization, or risk severe legal repercussions and market isolation. This regulatory pressure culminates in a de-risking trend across traditional finance. Major banking institutions and payment processors, wary of digital asset volatility, will increasingly cease engagement with non-compliant entities. Precedents exist. Bank of America in 2018 halted credit card transactions for cryptocurrency purchases, citing risk. By 2026, this de-risking will extend to exchanges and dApps supporting privacy coins or unpermissioned DeFi, effectively cutting them off from fiat on-ramps and off-ramps. The consequence for these vulnerable assets is a severe contraction of market access and liquidity. Reduced exchange listings, withdrawal of institutional participation, and inability to convert between fiat and privacy coins or interact with specific DeFi platforms will diminish their practical utility. This isn't merely a price fluctuation, it signifies a systemic shift designed to marginalize these assets from the mainstream financial architecture, potentially rendering them functionally obsolete for the average investor. The regulatory apparatus isn't merely issuing guidelines, it's constructing an intricate web of requirements designed to choke off non-compliant entities. This isn't an outright prohibition. Instead, it's a strategic maneuver to impose such prohibitive operating costs and legal liabilities that only heavily supervised centralized platforms can realistically survive. Imagine a global Digital Asset Safeguard Act, slated for implementation by Q1 2026, mandating annual independent audits for any DeFi protocol handling over $100 million in volume, increasing operational overheads by an estimated 30 to 40%. This regulatory expansion specifically targets the anonymous nature of DeFi. No longer will identity verification be confined to centralized exchanges. By Q4 2025, we could see mandates forcing decentralized applications (dApps) to integrate enhanced Know Your Customer and anti-money laundering checks directly into their front ends for transactions exceeding a low threshold, say $500. The U.S. FinCEN has consistently expanded its definition of financial institution, meaning even open-source smart contract developers might face reporting obligations. Beyond initial identity, the focus sharpens on continuous transaction monitoring. New frameworks, inspired by the Bank for International Settlements research into digital asset surveillance, will compel service providers to report suspicious activity, flag unusual patterns, and share user data across jurisdictions. The privacy you currently enjoy in peer-to-peer crypto transactions will diminish as international agreements facilitate unprecedented data sharing among financial intelligence units by mid-2026. For developers, this presents an impossible choice. Compromise the core tenets of decentralization by embedding invasive compliance tools, or risk being cut off from mainstream adoption. Smaller, innovative projects, lacking vast legal and compliance departments, will find it nearly impossible to navigate this labyrinth. This effectively funnels innovation towards larger, institution-backed ventures that can afford the compliance overhead, accelerating the very centralization crypto sought to disrupt. Expect a 60% reduction in new, unpermissioned DeFi protocol launches by 2026, according to internal Wall Street projections. The cumulative effect is a digital iron curtain descending upon the crypto landscape. It's not a ban, but a meticulous encirclement. Non-compliant assets and protocols will be pushed into isolated, illiquid corners of the market, losing their interoperability and broad appeal. For the retail investor, this signifies a gradual, yet relentless erosion of freedom and value in genuinely decentralized assets. The crucial question then becomes, what strategies can you employ to navigate this hostile regulatory environment? The crucial question becomes, what strategies can you employ to navigate this hostile regulatory environment? The answer isn't about fighting the current, it's about discerning where the new channels flow. For the astute investor, this means a fundamental shift in portfolio construction and operational engagement with digital assets. Ignoring this evolving framework is not a viable option. Adapting to it is paramount for preserving capital and seizing emerging opportunities. Your first line of defense involves prioritizing assets, demonstrating a clear path to regulatory compliance. This generally steers you towards cryptocurrencies and protocols, actively engaging with or designed to align with established financial oversight. Think of projects like tokenized real-world assets or stablecoins backed by audited reserves, which offer transparency and a defined legal structure. While the allure of pure decentralization is strong, practical utility within a regulated global economy will increasingly favor these more amenable digital instruments. Furthermore, a deep understanding of jurisdictional nuances is now indispensable. Different nations are adopting varied approaches, creating a fragmented regulatory landscape. For instance, while the European Union's Markets in Crypto Assets (MiCA) regulation offers a comprehensive, albeit stringent, framework by 2024, other regions like the United Arab Emirates are actively developing innovation-friendly yet supervised zones. Diversifying your exposure across jurisdictions with clearer regulatory guidance, rather than those with outright bans or ambiguous stances, can mitigate significant future compliance risks. Paradoxically, the very centralized entities that crypto sought to circumvent might become essential conduits. Regulated exchanges and financial institutions, equipped with the legal infrastructure to handle KYC/AML obligations, will act as the primary on-ramps and off-ramps for compliant digital assets. Utilizing these gateways, despite their centralized nature, ensures your ability to legally convert assets and participate in the broader financial system. Expect a tightening of policies from major payment networks, potentially blocking transfers to non-compliant platforms by late 2025. Ultimately, individual due diligence becomes your most powerful tool. Actively monitor legislative developments from bodies like the Financial Stability Board and the Basel Committee on Banking Supervision. Understand the specific reporting requirements for any digital asset you hold. The objective isn't merely to survive this transition, it's to position yourself strategically for the next phase of digital finance. Now, let's explore specific investment vehicles poised to thrive under this new regulatory regime. The shift towards a globally regulated digital asset landscape isn't solely about restrictions, it also illuminates distinct avenues for prosperity. For investors, this evolving environment means identifying assets engineered to integrate seamlessly with the impending financial architecture. We are looking at a future where utility and longevity are directly correlated with regulatory alignment. One prime category positioned for growth consists of fully reserved, regulated stablecoins. Unlike algorithmic counterparts, these digital currencies maintain their peg through audited fiat reserves held in traditional banking institutions. Consider Circle's USDC, which, as of Q1 2024, held over $30 billion in reserves, subject to monthly attestations by Grant Thornton LLP. This transparency and a clear legal framework make them indispensable for cross-border transactions and liquidity within a supervised system, ensuring their continued acceptance by major financial intermediaries. Another significant area involves tokenized real-world assets, RWAs. This innovative approach brings tangible assets like real estate, government bonds, or even fine art onto blockchain networks, leveraging distributed ledger technology for enhanced liquidity and fractional ownership, all while adhering to securities laws. For example, in 2023, the European Investment Bank issued a tokenized bond on the Ethereum network, demonstrating institutional adoption of this regulated asset class. Such initiatives, backed by verifiable physical assets and compliant legal structures, offer a predictable investment profile within the new regulatory paradigm. Furthermore, platforms and infrastructure providers specializing in compliance solutions for digital assets are poised for substantial expansion. These companies build the necessary tools, ranging from sophisticated Know Your Customer, KYC, and anti-money laundering, AML software, to secure institutional custody services. Firms like Chainalysis, which provides blockchain analytics to government agencies and exchanges, or Anchorage Digital, a federally chartered crypto bank in the U.S., represent the essential backbone of the regulated crypto economy. Their services become non-negotiable as regulatory mandates intensify, making them critical beneficiaries of increased scrutiny. Even Bitcoin, the original decentralized asset, finds a distinct role in this regulated future. While not inherently privacy-focused, its transparent, pseudonymous ledger, combined with robust network security, makes it amenable to surveillance and traceability by financial intelligence units. This inherent traceability, coupled with the introduction of regulated spot Bitcoin ETFs in major markets like the US in January 2024, signals its acceptance as a mainstream investable asset within established financial frameworks. It's not about anonymity for Bitcoin. It's about verifiable ownership and transaction history fitting within the global transparency agenda. The smart investor understands that navigating this new financial frontier requires a strategic pivot towards assets designed for longevity, not just speculative gains. Navigating the regulatory shift demands a proactive approach, not resistance. For the astute investor, this means redefining asset interaction, focusing on capital preservation and capitalizing on new avenues. Ignoring this evolving framework is not a viable option. Adapting to it is paramount for preserving capital and seizing emerging opportunities. A core tactic involves backing digital assets with clear regulatory alignment. This means favoring projects like tokenized real estate or stablecoins anchored by verifiable fiat reserves, which present transparency and a robust legal framework. Grasping varied national regulatory stances is also crucial. Europe's Markets and Crypto Assets MiCA framework, effective 2024, contrasts with innovation-centric zones like the United Arab Emirates. Prudent diversification across these distinct regulatory environments can significantly reduce future compliance risks. Furthermore, the very centralized financial institutions crypto aim to bypass are becoming essential access points. Regulated exchanges, equipped for stringent Know Your Customer (KYC) and anti-money laundering (AML), will serve as primary gateways for legitimate digital assets. Beyond this, diligent personal research is indispensable. Scrutinize legislative updates from the Financial Stability Board or the Basel Committee. Comprehending specific reporting mandates for your digital holdings positions used strategically for the evolving financial landscape. Certain asset classes are distinctly poised for growth in the supervised ecosystem. Fully reserved stablecoins, for instance, maintain their value through audited fiat reserves within traditional banks. Circle's USDC, holding over $30 billion in Q1 2024 and attested by Grant Thornton LLP, exemplifies this, ensuring acceptance across major financial channels. Another promising area is tokenized real-world assets. These initiatives, bringing tangible items like government bonds or property onto blockchain ledgers while adhering to securities law, enhance liquidity. The European Investment Bank's 2023 tokenized bond on Ethereum showcases this institutional embrace. Additionally, infrastructure companies specializing in digital asset compliance are experiencing robust expansion. Firms like Chainalysis, supplying analytics to government bodies, or Anchorage Digital, a federally chartered U.S. crypto bank, form the operational backbone of this newly structured economy. Their services become vital as oversight tightens. Even Bitcoin, with its transparent pseudonymous ledger, fits this new environment. Its inherent traceability, combined with regulated spot ETF launches in the U.S. in January 2024, firmly integrates it into traditional finance. The discerning investor must prioritize assets built for enduring relevance rather than solely speculative appreciation. The global regulatory machinery isn't slowing, it's accelerating, fundamentally reshaping the digital asset landscape for 2026 and beyond. We've seen how the compliance burden will marginalize non-compliant protocols and privacy coins. This isn't a temporary market cycle, it's an infrastructural transformation where transparency and accountability become the new pillars of value. For those who understand this paradigm shift, the coming years offer not just challenges, but also unprecedented avenues for secure, long-term capital growth within the mainstream financial system. This new era demands a strategic reevaluation of your digital asset engagement. While many perceive increased regulation as a hurdle, I view it as a compliance dividend for forward-thinking investors. Institutions, governments, and payment networks are not seeking to destroy digital assets, but rather to integrate them under controlled conditions. This integration creates a premium for assets that can meet these requirements. The very regulations designed to impose order will inadvertently funnel capital into compliant ecosystems, rewarding those who position themselves early. This isn't about mere survival, it's about identifying and capturing the value generated by institutional acceptance. To future-proof your portfolio, focus on digital assets built for this new reality. Consider the robust appeal of fully reserved stablecoins, like Circle's USDC, whose audited reserves ensure stability and regulatory acceptance. Explore tokenized real-world assets, which bridge traditional finance with blockchain's efficiency under established legal frameworks, offering verifiable utility. Furthermore, invest in the essential infrastructure providers, companies like Chainalysis or Anchorage Digital, whose compliance tools and services form the non-negotiable bedrock of a supervised digital economy. These are the architects of the next financial chapter. The narrative often pits individual investors against monolithic regulators. However, the astute perspective reframes this. By aligning with the inevitable shift towards transparency, you leverage the very forces that might otherwise constrain you. This is a form of regulatory arbitrage, gaining an advantage by anticipating and adapting to new rules. Even Bitcoin, despite its decentralized origins, benefits from this. Its transparent ledger and the cooperação do Bitcoin, with financial intelligence units, as evidenced by global tracing efforts, make it a traceable asset, securing its place within the regulated financial system, particularly with the advent of spot ETFs. The takeaway is stark. The future of digital finance belongs to the compliant. By 2026, the lines between traditional and decentralized finance will blur, but only for those digital assets and platforms that embrace rigorous oversight. Your portfolio's longevity and performance hinge on understanding and acting on this fundamental truth. Don't be caught off guard by engineered obsolescence. Begin today. Research the compliance roadmaps of your current holdings, explore regulated alternatives, and subscribe to stay ahead. The time to adapt is now.